Good day, ladies and gentlemen, and welcome to our very important webinar on understanding price charts, the keys to the financial markets. No matter what or how you want to trade, you cannot do so without having a full understanding of how to read price charts. Whether you're going to be a technical analyst or a fundamental analyst, no matter how you're going to trade, whether you're going to be using robotic trading or AIs or scanners or some secret method, it doesn't matter. You need to be able to read charts. Okay. And it's no secret that online trading can be performed more efficiently if you possess the necessary tools. So whether it's going to be fundamental analysis, technical analysis, quantitative analysis, there are many methods used by traders to predict the movement of an asset. Okay. But the fact is, if I were to call you tomorrow and give you some super secret tip on Google and tell you Google is going to skyrocket tomorrow because they have a new press release coming out, you still have to be able to look at the price on a chart to see if maybe my super secret information has already been shared with 1 million people and they've already pushed the price up. Or at what price would you be willing to enter the market? And at what price do you think the market gets saturated and will you get out of the market? Okay. You're not going to get that from my super secret information. I'm not going to tell you to buy it at 142, sell it at 149. Okay, I'm just going to give you some information. Now, on top of it, if I were to watch my Google hypothetical stock and it was at 142.94 and 142.99 and 144.47 and 142.42 and 144, and I'm watching the ticker taper, I'm watching the feed out from the internet, and then I say it dropped to 139.9, went back to 145.4, and went back to 144.7. Could you make any sense out of what I just said? Could you actually repeat it? And could you tell me what was happening? Nope, because our minds cannot visualize that unless we put it into some graphic depiction. So a price chart is simply a graphic depiction of the current and historic price of an asset. Now, charts have typically 3 display modes. Now, today with our incredibly great HTML charts and our Java charts, we're no longer charting by hand. When I started trading, we sat there with graph paper and we were drawing on every asset we followed the price on the charts. And that was a long consuming thing. And you couldn't then flip from one type of chart to another. And you couldn't add an indicator, subtract an indicator. You had to have, the ongoing indicator. Could you imagine putting a long-term indicator on a chart that you haven't used before and then you have to sit there and go back and draw it all in there? Nope. So today we have 3 display modes. So we have line charts, bar charts, and bar charts, and the big buzzword in our market is candlestick charts. So what we're looking at right now is a candlestick chart. Okay. Now, we can simply today change them to whatever means we want and change them back. Okay. So now we're looking at the most basic of them all. This is called a line chart. A line chart isn't used very much in financial markets because all you can do is see a general price move. Now remember, all price is historic and sealed and everybody has the same price. So when we're looking at the Euro US dollar 30-minute chart. At 8:30 this morning, the Euro closed that time segment at a very specific price, and it's the same price on my chart, your chart, somebody else's chart. We can also look in that time frame from 8 to 8:30 and see the highest it reached, the lowest it reached, the closed, and the open. These are sometimes known as OHLC. All charts are based on OHLC, open, high, low, and close. Almost all your indicators, because it's the only actual information outside of volume that we have. So a line chart simply, and I'm going to tell you 99.9% of the time, simply represents the close period of that time frame. So we're looking at a 30-minute chart. If I changed it to 1 hour, we would be looking at the end of 1 hour. Okay. And you know specifically what hour it is. So we know at 12 o'clock today, this was the close of the euro. Now, unfortunately, for too many of us, the world of computers and IT and development have given us way too many choices. Because as I said, the price is based on the close. But that's not so true anymore. Okay. Because our charts now, because what happened was all these people out there doing IT and development who know nothing about financial markets, they're just computer developers, just say, oh, look, I can give you all these choices. I can give you all this data. You're getting it all in. I can give you choices. So we could technically now get the line chart based on just the open price, or based on just the high price, or just the low or the close. Okay. But we can also get it with the high plus the low divided by 2. We can get it the high, the low, and the close divided by 3. All irrelevant pieces of information. Unfortunately, the more information and the more we can change data easily, the more these gurus that come along tell you, oh, you know what? My formula is very unique and you'll always make money if you use the line chart using the OHL divided by 3. Hogwash. Because we can look at this and we know it's the close. Okay. But unfortunately, just having a line chart that shows us the close doesn't give us enough information anyway. So from here we go to what was the old standard, which is a bar chart. Let's see. Let's fix this up so you can see it a little bit better. Okay, and why are they so? Oh, because a bar chart on the whole only remains black. Now we got another. Now there we go. Now this is a bar chart. A bar uses the open, the high, the low, and the close for the period. So each one of these bars represents 30 minutes. In this case, because we're only using a 30-minute chart. If we were using a one-day chart, it would represent the whole day. If we're using a 4-hour chart, it represents the price movement in that 4 hours. But a bar chart gives us an open, high, low, and close. So it goes, we draw that on the chart, and we can see now, we can start to see relationships between price. And sometimes the high is more important to you in relationship. If price is trending up, we should see the close close to the highs. If the close is coming near the lows, then price is a little wishy-washy. Because if price is moving up, we should be closing each period closer to the high because it should be continuing up. We also can see prices that have something in common. Whether it's a high, an open, a low, or close, but we can see that some specific price was very important to that asset at some period of time. Well, let's change this to a big, make that big and thick so you can see it well. So here, I just drew this. Look how strategic this price of 108,507 has been. Look at how many times price stopped. Look at all those lows on that price. Look at all the closes and the highs on that price. Every time price gets in that range, it's got something to do at that 108,507. So now we can see price that is relatively important. So when we start putting on the open, the high, low, and close, we're starting to decipher price movement. Okay. Now, today again, we can jump from one type of chart to another very easily. Okay. So now I've changed it to candlesticks. Now, Japanese candlesticks are the single most popular charting method in forex and CFD trading. Now, Japanese candlesticks have been around since the 17th century. Of course, we didn't have financial trading, we didn't have online trading, we didn't have computerized charts then. And rice traders used it to see where the price of rice was going. Now, Japanese candlesticks are also made up of what we see today as these red and green candlesticks. Now, people think that when they see lots of red, prices going up and they should be trading or buying, and when they see lots of red, prices going down and they should be selling. Well, unfortunately, that is a bad mistake, because Japanese candlesticks are really not about the amounts of reds and greens. Japanese candlesticks are all about the shape and the size of the body of a candle. So each one of these is called a candlestick. The red or the green area is the body of the candle. It's between the open and the close. If the close was higher than the open, it's a bullish trading session, and today we make it green. If the open is higher than the close, so in other words, it closed down, we make it red, and it was a bearish session. So we have OHLC, open, high, low, and close. And if you notice on this chart, the candles, the body of the candle, now the little black thing up above and below are those of the high and the low. Okay. Those are known as wicks or shadows. Okay. Each one of these forms a candle, but if you notice, the candles have different size bodies. They also have different size wicks. And these candles, the bodies of the candles and the wicks tell us something about price, not the red and the green. Then the relationship to the body of the candle and the size of the candle to the trend, and also the relationship between the current candle, the previous candle, and the candle before that tell us something very much about the markets. So candlesticks are more than looking at greens and reds. Now the fact is, you'll see lots of people talking about black and white, because in the old days when we were hand charting, you could draw a candlestick on your graph paper, which was time consuming, more time consuming than drawing a bar chart. And to make it easier, since you were only standing there with most time a mechanical pencil, is if it was a bearish session, you would just use the side of your pencil and fill in the candle. If it was a bullish session, you'd leave it empty. So you had technically white and black candles. Today, you can intermix it and you can make pink and orange candles. You can do purple and chartreuse. Doesn't matter. As long as you know which color is denoting bearish and which color is denoting bullish, that's perfectly fine. But now you see that there is 3 different kinds of charts. You also see that candlesticks are not based on necessarily color. You also see how you can easier see and depict price movement. Now, a lot of times I use bar charts and I use candlesticks. And today's, again, the advantage of today's modern chart is you can jump easily back and forth from one to the next. So sometimes drawing a trend line, seeing a price in common, is easier on the bar chart, but then you can, once you've got it drawn on there and you've seen it, you can then convert it over to your candlestick so that you can then interpret it better. But that's completely up to you. Today we have many choices. And as I mentioned, you also have time frames. So here we're looking at the Euro US dollar 30-minute chart. Okay, we see something happening. But if we went back into a 15-minute chart, we see the same thing, but we see something else happening in between. And now we see this sharp upturn, and we can imagine, if you're looking at a 30-minute chart, you only have one candle every 30 minutes. So if the price soared up in the first 15 minutes of that time and then stayed sideways in the next 15 minutes, you wouldn't see that in one 30-minute candle. You would just see the price soared up. When you break it down to smaller and smaller time frames, you get to see more increments. But then you get to see less about what the market and what the asset is doing. So a lot of us I particularly use a 1-hour chart for what I call environmental. It's when I decide whether I'm going to go long or short. I use a 30-minute chart to then determine my entry, my stop loss point, my target point, and verify my environmental look. And then I use my 15-minute chart to finalize and define the actual price in which I'm willing to enter the market and make sure I get in the market at a very, very good price. Okay. So we use multiple charts. Charts are also used to see things like chart patterns. Okay. A chart pattern you see on here, this is a triangle pattern. Triangle patterns are one of the most reliable patterns to develop on your chart, but you need to be able to read a chart to see this. And then there's formulas that you can enter on to this chart to determine whether you're going to go long or short and how far it's going to go and where to put your stop loss and where to enter the markets. Okay. Then we also have support and resistance levels. Remember, I said to you when we were looking at the bar chart, we could start to see numbers or prices where the price had a problem going up or down or bounced off of it. These are support and resistance levels. We see these on historic charts and they help us make sound trading decisions. So in other words, here we have our support zone. Support holds up price. Resistance is where it tries to push price down. It's like the floors of an elevator. The ceiling is your resistance. You have to break through it to keep moving up. The floor is your support. It's what pushing you up through that ceiling and holding you up. And then we also use charts for market structure. We can see specific things happening in the market by interpreting what price is doing. So there's many ways that we can use charts. So remember, all we can use is the open, the high, the low, and the close of the period. So as you see, a bar chart and a candlestick chart tell us the exact same pieces of information, just give it to us in a slightly different pictorial format. Now, one of the best reasons to learn how to read a chart correctly is so that you can apply technical analysis. Now, technical analysis includes those support and resistance lines, chart patterns, and then, of course, there's what everybody talks about, and those are technical indicators. And we mentioned about different time frames. It's one of the things you have to learn and get down and build a strategy for. Which time frames you want to use and how you want to analyze the markets. But then we want to be able to put indicators on our charts. Let me pop the charts back up here again. So we're back to my Euro US dollar chart. Okay. And I can place on here everything from a simple moving average, which is this blue line going through the middle of the price, okay, which helps smooth out price and helps us determine. There's a basic rule of thumb. It's the stop go method, okay, that all of us use. If price is above the moving average, not that we're going to make a trade, we would only consider a buy scenario. If price is below the moving average, we would only look at a sell scenario. So if all of our indicators are telling us to sell, but price is above the moving average, we wouldn't sell. It's what keeps you on the right side of the trend. Then we also have moving average strategies, which combine a combination of applying two different moving averages, and when they cross over, they give us buy and sell indicators, but that's only available on price chart. And then, of course, there are things like Bollinger Bands. Let me close these off. And we have indicators like Bollinger Bands that are technical indicators with mathematical formulas that are dropped over top of price that help us try to interpret price. And then lastly, we have technical indicators like MACD that are dropped below our chart and help us find buy and sell in areas, help us understand the momentum or the speed of the movement, help us find when price is overbought or oversold. But you can't do this without being able to read a price chart. So reading charts is very, very critical, and reading them correctly and understanding them. So we've talked about time frames. So regardless of how you want to trade, what information you want and how much you want to learn, regardless of your strategy, you need to put some basic lines on a chart that will help you understand the markets. And these are trend lines. Okay? Trend lines are a rule-based line that helps you start making determinations. But this trend line is an easy formula. You're just looking for 3 points that have touched that price, that it hasn't broken that price, and everybody around the world is using the same rule for a trend line. So that means millions of traders have the same trend line drawn on their charts. Well, you say, I don't want to do what everybody else does, but you do have to, because you have to know where the market's going to react to a price. You have to know what price is significantly important to all those traders around the globe, so that you know where you would want to see the markets act, and you'd want to see what the reactions are. Then we talked about support and resistance, the floors above and below the elevator. And lastly, we always want to have on our chart our volume. Volume tells you how many buyers or sellers, how many contracts, how many shares are being bought or sold. If you think that the market's going to go up and all your indicators tell you to buy, but volume is falling, that tells you the rest of the world doesn't think so. They're not entering the markets. So it gives you some reason. So if all your strategy has told you think price is going up, and you see that the volume of traders going into that asset is increasing and increasing, that tells you you're most likely right, because you need those buyers to be joining that market to push that price up. You can't affect the price market by your trade. You need somebody to, thousands and thousands of buyers to push that momentum. So you don't want to be the guy starting out pushing the rock. You want to see that people are pushing that rock up the hill already, and you want to join in to get that rock farther. Okay. So keep that in mind. So reading charts is critically important to everybody and anybody, no matter how they're going to trade, what they're going to trade, or why they're going to trade. So learn the basics, and then from there you can start putting all of these indicators and oscillators and learning to read price action. But first you have to learn how to look at your charts and decipher it. Then figuring out what price is trying to tell you, and adding indicators will come a lot easier. So thank you very much for joining us, and we'll talk to you again real soon.